Hello everyone, hope everyone is enjoying the summer. We're halfway through the year and it's been a pretty good first half, and hopefully we'll see some good weather over the next couple of months and avoid a lot of the catastrophes and finish with a really good year. Our combined ratio and return on equity through the first half of the year, through June, we've had quite a bit of improvement probably from the last time that I spoke with you. Our combined ratio through June is a 97.8, which is just right about on our year-to-date plan of 97.6. So we're pretty close. The loss ratio improved quite a bit. The expense ratio continues to have some temperature, primarily because of the lack of being able to hit our revenue plan. But all in all, through the first 6 months, 97.8 is a pretty good result. From an ROE perspective, we're just slightly below our plan. Our ROE was about 9.5 through June against a seasonalized or annualized plan of about 11.5. So we're a little bit behind there, primarily coming from the underwriting result, which we expect to continue to improve as the year goes on. But all in all, considering the level of catastrophe activity in the first quarter, you know, where we are financially is pretty good, and certainly it's very good against the rest of the industry. As far as our premium growth, as I mentioned, our expenses are lagging a bit, and that's primarily in relation to our premium growth. On a net basis, we're actually very close to flat, and that is really made up of within the let's say the direct business through the regional operations. We're pretty far behind plan there. Our personal lines business is slightly negative. Our commercial continues to be down quite a bit, around 6–7%, I believe. The commercial lines, much of that is driven by the extremely soft market. We just haven't seen the market hardening, and you know, our underwriters are practicing very good underwriting, very good pricing practices. It is, you know, I'll say again, it's much more important to get the right price for the account than to be writing an account that is inadequately priced, because you will pay for that eventually. So we're suffering some in our commercial operation from a growth standpoint. The good news is the commercial lines continues to perform very well from a combined ratio standpoint, down in the low 90s. Personal lines, we are seeing some decent growth, particularly out of the MVP states, and we expect that to continue. From a combined ratio standpoint, we're running a bit of a temperature in personal lines in the 105 range. The good news, though, is the combined ratio has dropped pretty dramatically over the last couple of months, and we hope to see that continue. But again, the business out of the regional operations is pretty far off plan. The bond operation is also off the premium plan. The reason we're able to keep our net business down around flat is because we are way ahead of plan in the assumed reinsurance operation, and that's due to some of the programs that we've put on. The program in Oklahoma, the program in Texas is actually running ahead of plan. The assumed program actually is probably going to finish the year they had a pretty aggressive plan this year, and they're probably going to exceed that by quite a bit. So when you kind of lump it all together, somewhere around flat, we expect assumed to continue its very good growth. We do expect to see a pickup in bond, personal, and commercial lines. We're rolling out our platform and expanded product. Where we have put that in, we're seeing dramatic growth, as evidenced in the 3 western states, what we call the Levitt states. And personal lines, as we continue to roll out the MVPs and the platforms, we're starting to see some momentum there. We should see an improvement in the overall revenue. Another piece to our financial result, obviously, is our investments. None of us want to live through 2008 again, and we repositioned our portfolio prudently and conservatively at the end of 2008. And that has reaped some pretty good dividends for us. You know, we obviously took a lot of volatility out. We aren't going to catch as much of the upside, but we're also not going to catch as much of the downside. We have a very quality bond portfolio that's performing very well this year. We've taken some nice gains, more so than we probably would have done in the past. So that has performed well. Our small equity allocation, that's performed well, and we're slowly We're slowly buying back in to the equity markets, and probably by the end of the year we will probably have that back up to somewhere in the high single digits. But kind of the bottom line through June, and obviously the investment result is fluctuates quite a bit from month to month, but through June we're ahead of plan, which is a very good result.